I'm going to discuss in this video how I manage my bond and treasury bill ladder. I use treasury bills primarily to fill up the short-term part of that ladder, meaning within 1 year. In the bond category, I include investment-grade corporate bonds, Tennessee municipal bonds, and treasury notes, mostly purchased in the secondary market to fill gaps that already exist in my bond ladder. Those treasury notes will generally have maturities 1 to 5 years from the date of purchase. I will also ladder treasury inflation protected securities in my Roth IRA accounts. The maturity range is currently from April 2025, when 4 tips mature, into 2034. I had 2 mature in 2025. It gives you just an idea of how they're stacked. Most of the tips that I currently own mature within 4 years, and all of them are owned in the Roth IRA accounts. My first guiding principle in constructing the bond ladder is to buy only investment-grade corporate bonds and Tennessee municipal bonds rated AA or higher. I'm not inclined to take on junk bond credit risk for a slight improvement in yield compared to treasuries or higher quality investment-grade bonds. The return of my money is an important consideration given my age and overall financial condition and the fact that I'm retired and do not want to go back to work. And my financial condition basically allows me to reduce reliance on riskier assets. The second guiding principle is to own a highly diversified individual bond portfolio, which means owning 300 to 400 different bonds, in addition to the treasury bills purchased at auction that will mature within a year or earlier, depending on which ones I buy. The maximum period for a treasury bill is 1 year. This mimics a bond fund diversity. Its only benefit, which is the only benefit from my perspective of a bond fund, and avoids the risk of bond funds that I've discussed in a prior video, which I will link in the More section below. When I buy an individual bond, I know to the penny what my total return will be, assuming that the issuer makes all interest payments and pays the principal amount at maturity. You never know that when you buy a bond fund. There's no guarantee they're even going to give you your original investment back if you have to sell shares. The third guiding principle is to have a constant flow of proceeds from maturing securities. And I may have overdone this because it's almost daily. This is primarily for the purpose of addressing the interest rate risk associated with rising interest rates that causes bond yields to go up and the price of existing bonds to go down. If rates are in an uptrend, I can redeploy proceeds quickly into higher yielding securities on a weekly basis, if not daily basis. Most weeks have multiple maturities during the week. The fourth guiding principle is that I need to know about the company issuing the bonds and to acquire enough knowledge where I can make a judgment on credit risk, which may turn out to be wrong, in addition to the credit risk assigned to the company's debt from the credit rating agencies like Fitch, Moody's, and S&P. I will always read at least one credit report, usually the one from Moody's, which is available at Fidelity, and sometimes adding a Fitch credit report, which can be accessed online when I want another credit agency opinion on the risk. I will always review the last earnings report when making this judgment about credit risk. And we'll look at the last filed 10Q on the SEC's website to see where the corporate bond that I'm thinking about buying fits into the maturity list. I prefer to buy the first bond to mature, and I'm talking about senior unsecured bonds and not the credit facility maturity. And if not that, the second one to mature. Sometimes I don't have that choice. I have to go deeper. The fifth guiding principle is that the duration of my bond ladder will generally fall in the 2 to 3 year range. It's a very short-term ladder focused on maturities within the next 0 to 3 years. I'm only now starting to buy corporate bonds that mature in 2028, and I've been buying some today, and I bought some yesterday, where I can pick up close to 5% YTMs on BBB plus, and one was an A minus rated corporate bond. The long end of my portfolio is Tennessee municipal bonds, but those can be called by the issuer at par value 10 years after the issuance, and I have surprisingly already lost several due to early calls. The uptick in intermediate and long-term interest rates since the Fed cut the federal funds rate by 50 basis points last September has made early calls of these municipal bonds less likely, but I still have one called nonetheless. I have a ladder for those as well, with my next maturity being in 2026 and multiple maturities every year after that to 2034, when the number of bonds that I own, Tennessee municipal bonds, falls off sharply. But I still have some maturities going out as far as 2046. Those will generate about $9,000 in tax-free interest to me each year. The sixth guiding principle is that I will limit my dollar exposure to how I assess the credit risk, recognizing that I may be wrong about that, but I at least want to have an informed opinion on it. I will generally buy in 1 or 2 bond lots even when I am willing to own 10. That is mostly due to managing interest rate risk associated with rising interest rates and declining bond prices. Given my short-term weighting in bonds and the constant flow of maturities, I am significantly less protected from a long period where interest rates decline, though I would expect my 2025 and 2026 interest income to be close to my 2024 number, which was a record for me, irrespective of what happens to interest rates based on what I already own. And I'm talking about interest rates declining significantly, which I do not expect, but then I can't predict the future. A lot of focus is just on managing risk and recognizing that I cannot predict the future. If I thought I could, maybe I should have a conservator appointed to manage my money. Interest rates may start to go up, or maybe they resume a downtrend. Today, the bond ghouls, for some reason, found something to like in the producer price inflation report, and the 10-year Treasury yield is down almost the same amount it was up yesterday. Producer prices were up 0.4% with the consensus at 0.3%, so it's hard to join the parade on that one. I will link a CNBC article discussing that report in the More section below. How do I keep track of all these bonds? I would like to have a free computer program that can do it for me. If I own the bonds in only one account, I could just keep track of them through looking at what was there in that one account. But I own corporate bonds in 4 taxable accounts and 2 Roth IRA accounts, Treasury bills and notes in 2 Roth IRA accounts and 3 taxable accounts, and Tennessee municipal bonds in 3 taxable accounts. Things tend to get lost. I will create a folder for each year that bonds mature. In that folder, I put snapshots of everything that is bought, arranging the snapshots by month and in time order within that month. When there are multiple snapshots for one security, I create a folder to put all of them in there. This is what the remaining maturities look like. I know you can't read for February. I know you can't read this, but you can see that I have some folders where I have multiple maturities, and that's what the remaining February looks like. Today, February 13th, I've already deleted the folder that contained 12 Treasury bills that matured today. The remainder of February, which has 36,000 in Treasury bills maturing, 4,000 in CDs, and 11,000 in corporate bonds. When I can no longer buy bonds and Treasury bills with yields to maturity over 4%, I will tend to start redeploying more money into dividend-paying stocks. In many of the corporate bonds that I own, I also own the individual common stocks, so I'm already familiar with the company through my stock ownership. At a 4% income return on my total brokerage assets, this is the reason I can reduce risk. I am able to pay all living expenses, including extraordinary expenses like the new roof I put on last year, after taxes, and invest about 30 or to 50% of the remaining income after tax and more income generating securities. So even though I've been retired for several years now, I have not actually invaded my principal with by $1 yet.